So the topic of conversation today is every year we do somewhat of a forecast or just outlook on what we think the year ahead might look like. As I've mentioned in several of these in the past, I'm not a big believer in just predicting on where the S&P is going to land or something like that. I really think it makes more sense because the data shows no one can really guess that accurately. It makes more sense to just look at what are the factors that are pushing markets in whatever direction they go, and how can we use that to make assumptions on either directional or how we should position money, or even just what to expect. So that's really the intent of today is to discuss what the outlook for 2026 is according to our view. And at the end, and hopefully I don't eat up too much of the time with just the outlook stuff, we also want to discuss some of the tax planning changes that have occurred this year. We're going to hit that real briefly. We may actually have to do a follow-up session that hits that a little bit more deeply because there's a lot of nuances that are happening with that as well. So, all right, without further ado, typical disclaimer, please don't act upon anything you hear. This is for educational, informational purposes only, just especially if you're not a client of ours. Talk to your advisor, talk to someone before just implementing anything you might hear today. All right, here's the basic agenda. We're going to spend most of the time discussing the market outlook and then obviously some tax and planning updates. So let's start here as I did last year. And this is a screen grab literally from last year's presentation. In fact, I almost thought about wearing the same shirt just because I thought it'd be funny. But anyway, I think I've gained a little weight since that picture too, but I digress. All right, so here what we listed is some of the unknowns that we felt in 2025 and then how that may impact the market. So what I want to do is cover those briefly because here's what I have found, having done this a while, is if you don't take the time to look backward, to understand, okay, here's the conditions we thought were going to happen relative to what actually happened, you don't tend to learn very much from those types of instances. So I think it's important we just pause and say, okay, what did we think might happen and what actually happened and what do we get right, what do we get wrong, not to pat ourselves on the back or anything, but just to learn from as we go forward, because that'll help shape how we recognize different conditions as they present themselves. So our view last year was inflation was likely to be tame. Remember, we had come off of huge inflation in 2022, aggressive rate hikes, et cetera. You know the whole playbook. We felt that inflation was likely to be tame. Well, in fact, this is a 5-year look at inflation, and inflation has remained tame. In fact, trivia question, see who gets this. In the past 75 years, does anyone have an idea what the long-term inflation rate has been over the past 75 years? I'll give you a quick second, not to Google that, but it's actually averaged 3.51 or roughly 3.5% is the long-term 75-year average of inflation. We're currently running at 2.71, so we're actually below long-term averages. And in fact, if you look at this chart, we've actually been running below that pretty significantly for over 2 years now. So the inflation worry works. I think the inflation worry is dead for right now. Now, what I hear people saying though, and here's the challenge, because look, I'm right there with you. You go to the store, you see prices that are significantly higher than they used to be. I will remind you that inflation is the rising of prices over time. Once, say, a gallon of milk goes from $3 to $4 a gallon, inflation could be zero. It does not mean that the price of a gallon of milk is going down. That would be deflation. So I find when I talk to people, they'll say things like, man, when are these prices going to come back down? The answer is they're probably not. It just means that the pace of the increase has come down to more normalized historical levels. Long-term inflation, there's a chart dating back to 1950. You see some spikes, but again, where we are today is actually a very normalized inflation rate. So, think back to where the Fed was acting a couple years ago, aggressive hikes. Uh, I think it's safe to say, at least right now, that they won the war on inflation and actually, in retrospect, probably navigated pretty well through that. All right, so that was inflation. The next unknown, financial conditions. 2025, we didn't know what Fed policy was going to be. We felt it was going to start normalizing, meaning interest rates declining from where they were, and that you would also get some sort of pro-growth out of Trump's first year, pro-growth tax policy. Both those things did occur. And so we had rates that ticked down a little bit. We had the tax legislation in the middle of the year. Both of those were supportive of stocks. Mortgage rates, our expectation was that they would be moderating close to 6%. This is a 1-year chart of the 30-year mortgage rate. They were roughly 7, a little over 7 a year ago, and they have moderated throughout the year, right around 6.09% currently. That's probably going to continue to gradually come down. We'll talk about what that means for the housing market shortly. Investor flows. So if you remember, we were discussing simply just how much cash had been built up on the sidelines. Money market balances were incredibly high, the highest in really history. So our view was that cash would start coming off the sidelines and that would be supportive of stock prices. This is the one that's got me puzzled because this is the cash balances in money market funds throughout the course of last year. Not only did cash not come out of those funds, except for a tiny blip in April, as you can see down here. Not only did cash not come out, but cash has continued to build. Balances are 12% higher than they used to be. We're up to, I want to say, over $7 trillion in cash on the sidelines now. So as it relates to our expectation last year, that did not pan out. And money market balances have continued to rise. Tariffs and deportations. Again, think back a year ago, we were discussing, you remember the tariff tantrum of March and April? We didn't know where all that was going. We didn't know what the impact would be. Deportations, we thought, okay, if that really starts in mass, what will that do to the labor market? And that could be a negative. And one of the things that is a little puzzling to some, and sometimes to me, is we think through, okay, we have all these tariffs that have been implemented. Why haven't those tariffs, remember all the fear that came in April, particularly last year, we had I want to say it was a 25% sell-off in April. What happened to all that fear about all those tariffs that were going to be implemented and how they would just derail the economy? Well, a couple reasons I think the market has done well in spite of all the tariffs and the tariff talk. One is, if you ever heard the acronym TACO, that is the acronym that has come about, and it stands for Trump always chickens out. And if you think back to a couple of our webinars in the past, I talked about how, look, I don't claim to know what Trump's thinking, and whether you like him or not doesn't matter, but you have to try to understand the lens at which he's looking through things. Trump looks at everything through the lens of a negotiation. And so when he's bombastic about putting on 100% tariffs on this country because they're doing something I don't like, et cetera, there really is more bark than there becomes bite. And so if you think through all the tariffs that were, thrown out there and then what actually happened is something we talked about last time. That's one of the reasons that the market hasn't been selling off dramatically because of that. The second reason is the AI boom is continuing and has continued. I think it was 2 years ago, we talked about in our annual outlook, really the super cycle that AI is and likely to be for a very long period of time. And that has not slowed down. And so I think a lot of that is helping to counteract a lot of the bite of the tariffs. And then essentially you have higher than expected economic conditions and earnings growth. That if you go back and look at expectations last year versus reality, a lot of things came in higher than people expected. So, having said that, I still think the tariffs are potentially an unresolved question. We're going to talk about them in our 26 outlook in a minute. But I don't know that we can say the jury's out on tariffs yet and what that might do. So far, they've been kind of a large non-event for the markets, but to be determined. Doge, we listed Doge as, hey, how aggressive are these Doge cuts going to be, et cetera. I kind of chuckle when I look at this now because, I mean, so Doge was Elon Musk and Vivek Ramaswamy going through the entire federal budget and really they're taking a hacksaw to everything. Uh, Whatever came of that, neither one of them are part of that now. I don't think any real cuts took place, which I guess is to be expected in the federal government. So, that really was just kind of a non-event. Corporate profits. We expected there to be continued expansion, a good business climate. So the market, or excuse me, the economy actually was more resilient than all the prognosticators expected. The economy in 2025, coming into the year, most economists were projecting muted economic growth somewhere around 1.5, maybe 2%. And what happened is economic growth was much more than that. And in fact, third quarter, it was trending over 3%. I believe it was over 4%. And then if you look at the data today, the actual numbers haven't come out yet, but it's trending toward literally the fourth quarter GDP being a whopping 5.4%. So GDP growth has been higher than forecasted. Corporate earnings continue to grow. Now, there were some real high estimates on corporate earnings growth in 2025, somewhere between 12 to 14%. Actual came in closer to 8. I think a lot of that has to do with a lot of capital expenditure, particularly as companies are investing in AI. If you look at the amount of capital expenditures in AI, it's mind-boggling. And so, yeah, that would take a small hit on earnings growth in the broad S&P, but again, that's companies believe that'll pay off, and more than likely it will. So, in other words, markets responded to resilience in spite of forecasts. So, I would say, yeah, corporate profits that kind of went as expected, and then sentiment. We were expecting sentiment, okay, which was very bearish starting the year, to become bullish. And when you get investor sentiment that is too bullish, that actually could be a bad thing. Well, this is interesting. Last year, the market was up, whatever, 16, 17%. And investors essentially remained pretty bearish throughout the whole year. And in fact, what I would tell you is, in talking to a number of you throughout the year, I was picking up on that same thing. I would consistently hear things like, I just don't see how this market can continue to go higher, Nick. There's all these fears out there. What about the tariffs? What about, you name it. We bombed Iran. Who would ever guess the market would be up after bombing Iran? So that's a remarkable thing that investors really pretty much stayed bearish throughout the year. And it wasn't, in fact, until really just recently, in the last couple of weeks, have things tilted more bullish. And so this is a survey that I commonly show you. And yeah, so we're seeing a little bit more bullishness currently, meaning like in the last week or two. And in fact, the fear greed index as of today is agreed. So we're finally seeing the bullishness that we thought we would see. It was a little later than we thought we'd see it. And again, that can be a positive for a while, but could eventually become a negative. So there's the scorecard from last year. Now, everyone really wants to know what's next. And as I sat and did a lot of research in preparation for this and in formulating thoughts, paying attention to a number of different voices and research analysts, I think we're actually in a very interesting environment, very, I would say, cautionary. Um, and so let's just talk about it. There is a wall of worry out there. And in talking to a number of you, I can feel it. So things like this is probably the most common one I hear is that stocks have had 3 consecutive years of just call it 20% plus gains. Last year was slightly under that, I know, but those are those are really big gains in a 3-year consecutive period. So the prevailing thought becomes that just can't continue. That just can't continue, Nick. Um, AI valuations. So all you've heard is AI, AI, AI. A lot of people are comparing it to the dot-com bubble in the late 90s. And if you remember that time, all you heard then was, "Man, this is a new economy. This is new technology. It's, valuations are different now, et cetera." And so there's a lot of concern whether we're entering an AI bubble. And we'll talk about that briefly too. Another wall of worry item. The nation is extremely divided politically and has been. And there doesn't seem to be any real resolution in sight to that. Social unrest. And there's a Supreme Court decision looming, and I don't know if many of you follow this or not, but regarding the tariffs. So we'll talk about that a little bit as well. And then, oh, by the way, another wall of worry is that we're getting a new Fed chair in 2026, and historically that has allowed for a little volatility, and we'll talk through that. But regarding that first one, where we got 3 consecutive really high years. This is Art Cashin. He's no longer with us. He was a stalwart on Wall Street for a long period of time. If you ever watched CNBC, you probably have seen him. Really smart guy. Has been around and seen everything in the markets. And he's noted as saying that bull markets don't die of old age. They die because they're killed by the Fed. And maybe he says that a little bit tongue in cheek, but if you look at data and history, that's actually pretty accurate. Okay. You ever heard the term, don't fight the Fed? You always have to think of market conditions and stock markets forward through the lens and the backdrop of what is the Fed doing? Okay. John Templeton, I think I shared this in another one. Bull markets are born in pessimism. They grow in skepticism. They mature on optimism, and they die in euphoria. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. And so, thinking through that lens, you always have to think, okay, well, where are we at right now? Candidly, I don't think we're in euphoria. And that's why I'll, kind of cliff notes, skip to the end. I don't think the bull market's over. But we're going to talk through some of the challenges that we face. I always love doing this too. Again, this is why I think it's somewhat a futile task to try to pick, how many percent the S&P is going to be up or down, or what the value is going to be. This was the consensus, all the top analysts on Wall Street last year and their predictions as to 2025. Pretty much everyone across the board was wrong. The S&P actually ended up over 6,800. No one was that high. Everyone undershot. And that was a 16.4% turn. So what do they all think this year since they got it right last year? Well, here's a compilation of a lot of the main Wall Street analysts and the firms they work for. I always do look at this just because I want to see what the thought process is. And in general, what you get is some kind of consensus that there's around an 11% return in the market. Like if you take the midpoint of that and just kind of average them out, that's what the consensus Wall Street experts are predicting. So that'd be double-digit returns again for the S&P. Well, is that realistic? Um, you know, somebody once said, history doesn't repeat itself, but it often rhymes. I think that's the way it goes. I'm probably misquoting that, but I found it to be extremely reliable in terms of its rhyming. So there's several January effect kind of rules, right? One's the first 5 days, and but this is looking at how the market performs in January relative to how it does the rest of the year. And this is absolutely amazing if anyone studies statistics and the probability of an occurrence happening repeatedly, you know, you can flip a coin a bunch of times and get, 50 heads, 50 tails. But since 1950, when January finishes in the green, so in other words, you have a positive January, the rest of the year has risen 87% of the time. 87%, that's a remarkable win rate. Okay. So if you look at the backdrop of history, the direction of the markets in January have a very high correlation and a very high probability of being similar to that. As of today, we're up, and I know we haven't closed out the month yet. Anything can happen, but it's looking like January is probably going to be a higher month. We'll see. Having said that, this is something I feel is it's something we all need to be mindful of because I can see these conditions starting to percolate where at some point in 2026, I could see a pretty significant sell-off at some point in the year. So what could cause that? Why would I say that? And that's not to be alarmist because I'll tie it up in a minute. Well, there's a couple reasons. One is probably in the next couple months, there's a Supreme Court decision on whether the tariffs are legal or not. And based on what I've read, the Constitution seems pretty clear that Congress is the only authority that can impose or raise or change tax law. And tariffs, by and large, are taxes. Now, obviously, the Trump administration is going to have a different view. The Trump administration essentially used emergency powers to implement the tariffs. So there's a lot of constitutional law that comes into place on, okay, where's the boundaries of presidential powers under emergency conditions and et cetera. But a large majority of the legal experts believe, as do I, that it's highly probable the Supreme Court will essentially overturn and say, nope, those tariffs were illegal, essentially. And the fallout of that could be pretty volatile. If it comes down to the point where they say that, the tariff revenue has to be repaid, I want to say it's in the hundreds of billions, I believe now. I mean, if $100 billion check has to be, struck to different countries around the world, what will that do to deficits? What will the bond markets do at that time? So I think this and the volatility around that could be something that helps perpetuate a downturn. The other is, as I mentioned, we have a new Fed chair in 2026. And throughout the lens of history, when you get a new Fed chair, it has historically been accurate that the Fed chairs will get tested, usually in the early part of their first term. Alan Greenspan absolutely was. I want to say it was 3 months in. You had Black Monday, 1987. and had to act um, with interest rate decisions. You had Ben Bernanke. I want to say in the first year of his term, we started entering the great financial crisis. I think Janet Yellen was probably the outlier where she didn't have too much of a test in the early going. I'd have to go back and look again. Jerome Powell, I mean, COVID and the whole Fed response to it. Now, I'm not saying that we're setting ourselves up for the great financial crisis or another COVID or something like that. But what happens is, we're going to have a new Fed president that is selected by Trump, who is going to be selected because he's going to be very accommodative. Trump wants to lower interest rates. So he's going to find someone he believes will continue to lower interest rates so the economy continues to boom. Well, there's going to be this push and pull between the independence of the Fed in relation to, okay, what are the political ties to the president and his wishes? And so I can see a scenario where he gets tested, where the bond market really tests in terms of interest rate swings, and we get some pretty significant volatility that could occur through that. Um, Now, if you also look at more of a technical backdrop as to where we are now versus what's being set up. So I've shown you these types of charts probably every time, and I don't put 100% weight into trends and technicians and all of that. But I also think you would be doing yourself a disservice if you didn't at least be mindful of trends and support and resistance levels. And so, if we look at this is a chart of the S&P 500, okay, and you see this pretty defined channel really dating back to 2018 or so, where we've been in this upward bull market, and it's been a great upward bull market. You see the dips along the way. There's COVID, that steep decline in 2020. There's 2022 and the largest interest rate increases in history to combat inflation. You see, the substantial rise since then, and then there we are last year. That was the tariff tantrum, okay, and yeah, that was a pretty significant, steep, short-term decline. But we've been in this trend, right, and we are currently at the high end of the trend line. Now, again, that doesn't mean that we're ripe for a pullback. It doesn't mean that it's going to be sharp. It doesn't mean we're going to bear market. I just think we just need to be mindful that we're on the higher end of a trend range. And if we do have some of these conditions present that I just explained, then it is highly possible we get some retracement, okay? So again, a little shorter term chart. And I want to say this is not Nick trying to predict what the markets are going to do. I have no idea, okay? And neither do you, and neither does the smartest guys or gals on Wall Street. But I could easily see something happen where we do get a sell-off throughout the year, okay? And what I've noticed in the last 10 years is because of, high frequency trading, algorithms, we now have expansive ability for people to access markets like we didn't have, 40 years ago. That's why it seems that these sell-offs and these moves in the market seem to be quick and volatile and drastic. And so, sure, I could see some significant quick movements in the market. All right. Now, again, that's not to scare you. And it's also isn't necessarily going out on a limb because look at this chart. This was one of the best charts I've seen in a while because inevitably, when we go through dips or declines in the market, like 2020, like 2022, like last year, I start getting, calls, comments from maybe some of you, from other clients, from other people I talk to saying, Okay, well, what should I do? Like, this is, maybe should I get out? Like, I can't handle this volatility, et cetera. Well, again, take some comfort because this is a chart showing the S&P, okay, yearly returns dating back to 1980. So pretty long data sample. Okay. Average drops in any given year, the average decline is 14.2%. So let me say that differently. In any given year, it's highly likely that from the high point to a low point of any decline is going to be a 14.2% move. That's the average move. Some have been higher, some have been lower. But I mean, there's some very significant drops in here. Minus 34, minus 30, minus 34. But yet, annual returns over that 46-year period, 35 of them have been positive. So in other words, I think it's a 76% win rate, even with an average decline of over 14% on average every year. So I say that in hopes of you receiving this the right way. That yes, while I think it's highly possible we're going to get a pretty significant whipsaw at some point this year, that's within the realm of normal. And that is almost to be expected. So that's not why I'm not going out on a limb. I can see things starting to percolate. I can easily see this happening. It's well within the confines of history, and it's actually a normal phenomena. So take that to heart. Now, one of the things I think I've shown this every time, and I'm probably going to show it every time because it's that important. Okay, market cycles are linked to emotional responses. So as markets increase, okay, we go from optimism to excitement and thrill and then euphoria. And that euphoria is when that peak occurs. The point at which you feel the best, the point at which you feel there's very little risk in this investment is the point of maximum potential risk and the point in which it's likely not going to go up much further. So you have these market swings, these emotional swings, and then so as something goes down off that euphoric state, you have a little anxieties that go down, and it turns to denial, and then fear, depression, and then all the way down to panic and capitulation. In those moments, guess what? You feel the worst, but the least amount of downside risk is likely there, and the most amount of upside potential is there. So I want us to always continue to remember that. So when we go through another period, like we might do, like we have in April, and remember this, because when you feel extremely fearful and panicky, usually you're in the latter stages of that decline. Well, I always get, well, Nick, I mean, black swan events? And you know what? If we sat and we planned on a large scale black swan event to occur every year, you would never invest in anything and you would lose money to inflation because you're too fearful. But they do happen. Here's what I find is interesting. You could argue that we have had 6 black swan events in the last 5 years. So, don't believe me? I guess almost the last 6 years now, but all right. We had 2020, we had the COVID shutdown. 2021, you had this bullwhip of supply chain, okay, causing mass inflation, etc. 2022, you had the full inflation cycle. 2022 and 23, you had the fastest Fed hikes in history. In April of last year, you had the tariff tantrum. And then this is the one that I swear it just amazes me because A, people have forgotten about it already, but B, if I would have told you last year, hey, we feel really good about the markets, we think they're going to be up, but there's a pretty high likelihood that we're going to bomb Iran's nuclear facilities. Every single one of you would have said, whoa, that doesn't sound like an environment to invest in me. That to me sounds like we could be starting World War III. I don't know that that's a good idea. We should not be investing. Yet, what happened? The market absorbed it. So the point there is I would caution you against this black swan event thinking because it really will paralyze you. In that period of time, if you were emotional, it probably would have kept you out of the market and you would have missed a very substantial run up. All right, so all that, let's boil it down into a similar framework for 2026 in terms of how we feel about different factors that are going to play and what that might, the impact it might be on stocks. Well, let's start with inflation again. I don't think inflation is anything that's likely to be be top priority or take center stage this year. I think it'll more than likely stay calm unless we get some really aggressive rate cuts by a new Fed president. But even then, he or she's going to have to navigate the whole Fed board to do that. So I think inflation is going to be tame. That's a good thing for stocks. 2026 is a midterm election year. Currently, there's a lot of political division. I don't see that getting any better before midterms. More than likely, it's going to get worse. So I think you're going to see political contentiousness. But here's the fascinating thing. If you look at how markets perform in different, and I've shown some of these slides before, in different political makeups, the market actually really likes a split governance, where you have one party in power in presidency and the other party in power in the Congress. Betting odds right now are showing that likely the Democrats will take the House, possibly the Senate. And so, yeah, it's highly likely we'll get a divided government, which ultimately, historically, has been good for stocks. So the impact we see here is, it's probably going to have a little downward pressure on stocks. Political season gets really ramped up. But the resolution of that eventually, I think, will be positive. Okay, Federal Reserve. We are expecting rates to continue to be lowered. I'm not sure the pace of that. Part of that's going to depend on the next Fed chair. But I do think it's, like I said, very likely that we could get some bond market whipsawing in different types of economic and market events that will test the resolve of the new Fed chair. And so ultimately, those lower rates will be beneficial for stocks, but I do think there's some volatility potentially along the way. Tariffs. So it seems to me like the Supreme Court is probably going to overturn the tariffs. I think that will lead to some market volatility and probably is some tough going in the market for a period of time there. Real estate. I think there's a housing recovery that's underway. Rates are a big part of that. And that's ultimately good for stocks. And as I mentioned, there's a wall of worry. Some of it's included in this outlook, some of it isn't. But the thing I think you should be mindful of and remember is that markets climb a wall of worry. And that has been historically accurate as long as markets have been around. So if there's something that that in general investors are worried about, usually that's a good set of conditions to continue to invest. Corporate profits, I think there will continue to be an economic expansion, good business climate, et cetera. And then sentiment. So sentiment is a lagging indicator. What I mean by that is people feel better after they've seen the markets go up, after they've seen their 401ks go up in value, etc. So that's a lagging or a trailing factor. Market will lead, sentiment will follow. Well, by the time sentiment usually gets overly bullish, okay, that's usually the time where it shifts. And so we're at fairly bullish, levels now, not extreme bullishness, but fairly bullish. I think that'll continue. I wouldn't surprise me if, the next couple of months the market are really good. But again, then you're going to have this capitulation in the markets, probably going to, at some point, have a little volatility to it, and we'll swing over to the bear side again, which will be nice and cleansing for the market and market participants. So ultimately, will be good for stocks after probably a little bit of a challenging ride. So, in closing, in terms of the market, a couple things that I just want to remind you of. I feel good about the long-term prospects of the market. We're still in an expansionary stage. We're still in markets that are likely to go up over time. Honestly, I actually think that 2026 will be an up year, if I had to guess. I just think it could get a little volatile along the way. So I just want to prepare you for that. And I also, the one thing that I'll remind you of when you look at your own situation, everyone gets locked in on high water marks. So, if I have $1 million in this account, and man, it was up to 1.2 million, and now it's down to 1.1. You know, they get locked in and fixated on that highest watermark, okay, in terms of how well they're doing. I would caution you against that. I've always said don't get too high on the highs, don't get too on the lows. Really, we're just looking for trend, okay? And when it comes to your investments and in regards to how we plan, we're looking for averages, okay? And from an investment standpoint, we will make changes, right, as we see fit. But really, that's just kind of, some situational, strategic kind of, rebalancing, so to speak. We're not going to be in and out of the markets in big swings. In fact, there's it's called the rule of 10 days, I think is what's called. But, there's data that I could share with you at some point if you're really interested, showing that if you are out of the market for the 10 best days in any year, which guess when they tend to happen, after those big sell-offs. If you're out of the market in those periods, the amount of money you lose in terms of your average return drops dramatically. So let's keep the right mindset and framework. It's our job to help you with that. Obviously, if you get too gung-ho or too fearful, we're going to kind of, talk through that with you. But that's essentially, that's how you win. That's how you win, staying invested in the markets and not making huge timing decisions. All right, I want to move on from there. Hopefully that addresses and give you some level of comfort, to some tax and planning updates. Now, again, there's a lot here. We probably need to have some kind of follow-up on this now that the OBBB, BBA, whatever it is, was passed last July, and people can start to understand it now. There's still a lot that's getting fleshed out by IRS rules, by the way. So here we are, 2026 tax and planning updates. I know it's a lot of words, so let's break it down. The One Big Beautiful Bill Act, that was passed last July. There were some of those, and we did a webinar on this, that went into effect immediately. Some are phased in over time. Some of these are permanent, and some are not. Some of them go away after a few years. So permanently, here's some of the things that happen. Now, when I say permanently, remember, there's no real such thing as permanent in tax law. Permanent just means that there's no scheduled expiration. Congress is going to change tax law again at some point, and so nothing's permanent until it's all permanent until they change the law. This is really what it boils down to. So, but it permanently extends the Tax Cut and Job Act marginal rates, which went into effect in 2018. The lowest rates in really recorded history. Uh, Many of you received a tax deduction when they went into effect. They were scheduled to revert back to the former rates. This now makes them permanent. There is a temporary, and this is the big one. There's a temporary enhanced deduction for seniors that I'll cover in a little bit more specificity here in a minute. It also increased the SALT deduction, the state and local tax deductions. In other words, your property taxes, the income taxes you pay in different states, the ability to deduct those off your federal return. That had been dropped to capped at 10,000, and so particularly a lot of people in these high tax states, they didn't like that. So that deduction cap is now up to 40,000. However, A, it's temporary, and B, it does phase out. So I want to say over 500,000 of income, it starts phasing out. So again, just be mindful of that. There are, taxes on tips and overtime was changed, and then there was some energy credits that were cut. We won't go into that. The standard deduction for this year, married filing jointly, is 32,200, and for single filer is 16,100. The standard deduction and the rise in standard deduction over the last, say, 5-6 years. What it means is I want to say something like 90+% of people take the standard deduction now and don't even itemize. And so it's important for you to understand which tax benefits, deductions, etc., that you get if you itemize versus if you just take the standard deduction. Because I find a lot of people confuse the two. They think they're getting some tax benefit for something, whether it's mortgage interest or charitable deductions or something, but they're only taking the standard deduction, and so they don't even realize that they're not getting any benefit for this. So let's talk about the senior enhanced deduction now. This, of course, is temporary. Now, it wouldn't surprise me because, again, it expires in 2028. Guess what's in 2028? It's an election year. So this is going to end up becoming a campaign topic because all these seniors, their taxes are going up if so-and-so gets elected or not. You just mark my words, it's coming. But here's how it works, and it actually is a fairly significant deal. So for seniors age 65 and older, there's a bonus deduction of $6,000 per individual. So if you're married and both of you are 65 and older, that's an extra $12,000 added on top of that married filing jointly deduction. Oh, as well as there's already another senior deduction before that, I think of $2,000. So it starts inching up quite a bit. Now, this expires in 2028. You have to be 65 by the end of the year, okay, for this to qualify for you. And here are the phase outs. A single filer, it starts phasing out at 75,000 of AGI, adjusted gross income. All right. And then once you get to over 175,000, it completely phases out. Married filing jointly, it starts phasing out at 150,000 of your adjusted gross income. And then it fully phases out once you get over 250. Now, here's why this is important. We've been, Steve and I have been doing some calculations on various different situations. And one, it impacts the feasibility of doing things like Roth conversions. There's actually a very big impact this has now. So that's why I tell you, if don't just arbitrarily do a Roth conversion or, whether it's capital gains, whatever it might be, because it might start impacting some of this, and you might not realize, and it might trigger certain phase outs of certain deductions. But the second thing is, um, you know, we have a lot of clients who are 65 plus that are either still working or they're doing some consulting income, or they want to earn some level of income because it's fun. This is a big deal. And so I think it's important to have planning conversations with us around, like, if you want to do some sort of consulting gig, or you want to do some side hustle, make a little bit of money somewhere. Let's have a conversation to make sure that you're not going to arbitrarily start triggering something in a phase out of what could be a really great benefit by doing so. All right. What is the reason that you have this enhanced senior deduction? The reason is, if you remember on the campaign trail, no tax on Social Security. Um, well, and you even still, I think I just heard Trump the other day say, we eliminated taxes on Social Security. That's not really what happened. They actually weren't able to change the tax law for Social Security. They didn't have enough votes. They had to do it through the reconciliation process. So this is what they came up with instead. Now, in effect, what it does is, yeah, for probably around 88% of people who receive Social Security, it does essentially make their Social Security non-taxable, but it is not truly no tax on Social Security. They're doing it through an enhanced extra deduction for somebody who's 65 or older. The other thing I'll tell you is, you do not have to be receiving Social Security benefits to receive this enhanced deduction. There's some confusion about that too. So this is it regardless. The only trigger is your age and your adjusted gross income. All right, I'm running out of time. I'm going to move on. Again, we probably need to hit some of this again in another session. But this is the point here. This enhanced senior deduction. So a married filing jointly couple who are both over 60 or 65 or over, you're getting a 32,200 standard deduction. Okay, you're getting another 3,300 because there is this other senior deduction that came around not too terribly long ago. And then from the One Big Beautiful Bill Act, you're getting this enhanced senior deduction of a total of 12,000. So that means that this couple essentially has a total, for lack of a better word, standard deduction of 47,500. That's substantial. That is essentially the first 47,500 of income you create is not taxable. So it's a really big deal. And again, it starts bleeding into a lot of planning conversations around, okay, should I create extra income or not? Because I might start losing some of this. So again, that's something that we really need to talk through and do some planning around. All right. I need to move on because I'm pushing up against time. Okay. IRA contribution limits increased. There's new 401k employee contribution limits. Make sure you go through and increase your 401k amounts to the new maximums. A lot of people just assume that it kind of happens, and it usually doesn't. You have to actively increase to make sure you're getting that benefit. Also, if you're in the new age range, okay? So let's say you're 50 now this year. So between 50 and 59, or if you're 64 and older, you get another 8,000 to put in. That doesn't happen automatically. You got to talk to your payroll administrator or your HR benefits to get that done. Okay. This is the year, you may have heard of this, catch-up contributions in your 401k, your employer-sponsored plan, has to be Roth. So in other words, those catch-ups are now going to be Roth or after tax. So you're not getting an extra tax break for that. There's been some pushback to this. A lot of people don't like it. It is what it is. All right. Separate limit. That's okay. And child tax credit. Again, I'm gonna blow through these. I know. I'm sorry. These slides, we can send them to you, and this presentation will be available on YouTube, as I mentioned. Gift exclusion stays at 19,000. Lifetime gift tax exemption is at 15 million now per person, which means fewer and fewer people are having some sort of true taxable estate. Qualified charitable distribution is 111,000. Remember, this QCD, qualified charitable distribution, is the ability to give straight from your IRA, okay, to a qualified charity, and it's never received as income. Now, the reason it's age 70 and a half is it used to be linked to when you had a required distribution, but those required distribution ages have increased. Now it's 73, and for some of you it's 75. But the QCD age has stayed at 70 and a half. So this is something to be mindful of, that at age 70 and a half, you can start making qualified charitable distributions, taking money directly from your IRA and sending it to a charitable organization, and it is never considered income to you. Great strategy. We do it all the time. If you have questions about it, just contact us. All right, this is important too. I hate that I'm flying through these, but charitable contribution deduction for people who take the standard deduction. Remember, most people nowadays are taking the standard deduction. And up until now, if you gave money to charity and you were taking the standard deduction, you did not get any real tax benefit from that at all. However, this year that's changed. So filers who take the standard deduction, if you're single, you get a deduction up to $1,000 of charitable donations. Now, these have to be cash donations, not stock donations. Married filing jointly, that deduction is up to $2,000 of charitable donations. So, for those taking the standard deduction and you're normally charitable, make sure you hit these. Okay, this is a big deal. Itemized deductions of charitable donations, that's changing. You're not getting quite the benefit. There's a 0.5% floor that has to be exceeded now, and then the deductions are capped at 35, even in the highest tax rate. Okay, Social Security benefits increased. There's a car interest deduction. If you have questions about that, we can talk through that. It's available even if you take the standard deduction, and it has to do with the interest on, but it's got to be a new car. It's got to be a U.S. assembled car, and there's some rules around it. And then Trump accounts. I think this is the last thing I've got here. Trump accounts, you've probably heard about them. They're going to be essentially coming out middle part of this year. Anyone who was born between 2025 and 2028 will be eligible for these. A lot of information still forthcoming about this. Essentially, the government's going to seed $1,000 into it. It allows for contributions from anyone. Could be grandparents, could be you, could be whoever, of up to $5,000 that goes in. It grows tax-free. At 18 or older, it can be essentially converted to an IRA. There's some nuances that, again, we just need to be aware of, but we can talk through that. And we're going to keep it there. So, thank you. Thank you for your time. For those of you that have hung on, I don't know, there might be 0 participants left in this by now, but we want to say thank you. Hopefully this was informative. Hopefully it helped shed some light on our thinking going forward. And obviously we're available for any questions, comments, feedback. For those that have left a Google review, we've had a few more lately that have left Google reviews. We want to say that we really appreciate that. And we'll see you next time. Thanks.